The origin story of money, from stones to the digital age. Have you ever stopped to think about the paper in your wallet or the numbers on your banking app? We use money every single day, yet we rarely question what it is, where it comes from, or why it holds such a powerful sway over our lives. Money feels so natural to us that we might assume it has always existed in its current form. But the story of money is a fascinating journey that stretches back thousands of years, an evolution driven by human ingenuity, necessity, and trust. To truly understand our modern economy, we have to start at the very beginning, long before the first coin was ever minted. Imagine a time before money. How did people get what they needed? This was the era of bartering. If you were a farmer who grew wheat, and your neighbor was a baker, you might trade a sack of your wheat for a loaf of his bread. On the surface, this system seems simple and perfectly fair. And in small, self-contained communities, it worked well enough. But if you dig a little deeper, you find that bartering was riddled with hidden complexities and frustrations. Its biggest flaw was a concept economists call the double coincidence of wants. For a trade to happen, you had to find someone who not only had exactly what you wanted, but who also wanted exactly what you had. What if the baker didn't need wheat right now, but wanted wool for a new coat? The entire system would grind to a halt. You couldn't get the bread you needed, and the baker couldn't get the wool he wanted, all because the right people with the right goods couldn't be found at the right time. Beyond this, bartering had other major underwater stones. Perishability was a huge issue. You couldn't save up a season's worth of fresh fruit to buy a piece of furniture a year later. The value would rot away. Indivisibility was another problem. How do you trade a cow for a bushel of apples? You can't exactly cut the cow in half. These inherent limitations made it incredibly difficult to accumulate wealth or engage in complex trade. A solution was needed, and it came in the form of a revolutionary idea. This problem led to the first major innovation in the history of money, commodity money. Instead of relying on a direct trade, people began to use certain goods that were widely desired and had a consistent value as a medium of exchange. These goods weren't just a part of a trade, they became money, because everyone agreed they had value. In some places, this was salt, which was essential for preserving food. In others, it was cattle, which represented wealth and sustenance. On the remote Pacific island of Yap, they used massive, donut-shaped limestone discs called rye stones as currency. While they were too big to move, their ownership was publicly known and tracked, showing that money doesn't even need to be portable to work, as long as it's a trusted symbol of value. The key was that these goods solved the problem of the double coincidence of wants. Now, you could sell your wheat for salt, and then use that salt to buy a chicken from a third person, even if they had no use for your wheat. Money had become a universal translator for value, an agreed-upon placeholder for economic worth. Over time, certain commodities proved to be better forms of money than others. The best types of money were durable, they didn't spoil or break easily, portable, easy to carry, divisible, could be broken into smaller units, and rare enough that their value was stable. This is where precious metals like gold and silver really started to shine. They were durable, could be melted down and divided into any size, and their natural rarity meant they held their value. They were the perfect commodity money. This led to a crucial moment in history, around 600 BC, in the Kingdom of Lydia, in modern-day Turkey. The Lydians are often credited with inventing the first standardized coins. Small, stamped pieces of a gold and silver alloy called electrum. These coins, with their official stamp, were a massive step forward. You no longer had to weigh a chunk of gold every time you made a transaction or test its purity. You could simply count the coins and trust the government's guarantee. This invention fueled a rapid expansion of trade and wealth, helping to build states and empires. Money had become a powerful tool for social and economic organization. But gold and silver coins, despite their many advantages, still had their own underwater stones. They were incredibly heavy to carry around in large quantities, making long-distance trade risky and inefficient. And they were, of course, highly susceptible to theft. This led to the next big leap: paper money. The first paper money was not money in the sense we know it today. It was more like a receipt for a deposit. People would take their heavy gold coins to a trusted person, like a goldsmith, and leave them for safekeeping in a secure vault. The goldsmith would give them a piece of paper, a note, stating that the person had a certain amount of gold stored with him. These paper notes were much easier to carry and trade than the actual gold. Over time, people realized that they could simply trade the notes directly with each other without ever having to go back to the goldsmith to redeem the gold. As long as everyone trusted that the note could be redeemed for real gold at any time, the note itself began to function as money. The goldsmiths, being shrewd businessmen, noticed that most people never came back for their gold at the same time. They realized they could lend out some of the gold they were holding to others and collect interest, all while the paper notes circulated as currency. This was the birth of the modern banking system and a concept that would later become known as fractional reserve banking. This was the dawn of representative money, money that represents a physical commodity held in reserve. This system, known as the gold standard, dominated the global economy for centuries. Governments would print paper money, but they promised that for every dollar or pound in circulation, they had a corresponding amount of gold in a vault. This gave people a tremendous amount of confidence that their money had real, tangible value. But even the gold standard had its constraints and drawbacks. Economic growth often required more money to be in circulation to keep prices stable and facilitate more trade. But the amount of money a country could print was strictly limited by how much gold it possessed. This meant that the economy couldn't always expand as fast as it could in theory. If a country ran out of gold, it couldn't print more money to stimulate its economy or respond to a crisis, such as a war or a famine. This rigidity was a significant problem, and it was a major factor that intensified the Great Depression in the 1930s. Countries that held on to the gold standard found it much harder to recover. The final and biggest shift came when money became fiat money. The word fiat is Latin for "let it be done," and it means that the money's value comes solely from government decree. Fiat money is not backed by gold, silver, or any physical commodity. It is valuable because a government says it is and because people have faith that others will accept it as payment. Governments declared their currencies legal tender, meaning that all debts, public and private, must be paid in that currency. When the U.S. government officially ended the gold standard in the 1970s under President Richard Nixon, it marked the end of an era. Money was no longer tied to a physical object, its value was based on trust in the government and the stability of the economy. This transition to fiat money was one of the most profound and controversial shifts in economic history. On one hand, it freed governments and central banks to manage the economy in a much more flexible way. They could print more money during a recession to boost spending or reduce the amount of money in circulation to fight inflation. But this flexibility also came with a huge, underwater stone, the risk of inflation. If a government prints too much money without a corresponding increase in the goods and services available in the economy, the value of each unit of money goes down. Prices go up, and your money buys less than it used to. This is why a dollar today buys far less than a dollar did 50 years ago. This new system put enormous power in the hands of central banks and governments, but it also placed a massive responsibility on them to manage the money supply wisely. The modern world of digital money and the mystery of its creation. In today's world, the vast majority of money isn't a physical object you can hold, it's a digital entry, a number on a screen. This brings us to the biggest and most misunderstood part of the money story. How is money created in our modern, digital economy? It's a process so common and yet so profound that it sounds like magic. The popular belief is that the government or the central bank is responsible for printing money and injecting it into the economy. While governments do print physical cash, this accounts for a very small fraction of the total money supply. The real engine of money creation isn't a printing press, it's a bank's computer. The magic happens inside commercial banks every time they give out a loan. This is where banks type money into existence. This might sound wild, so let's break it down in detail. Imagine you're a home buyer. You go to a bank and apply for a $300,000 mortgage. A bank doesn't go to its vault, pull out $300,000 in cash, and hand it to you. It doesn't even take $300,000 from its other customers' savings accounts. Instead, when the bank approves your loan, it simply creates a new deposit in your bank account for $300,000. It literally types the numbers into a computer. Just like that, a brand new $300,000 comes into existence and becomes part of the total money supply. It's not a transfer, it's an act of creation, backed by your promise to pay it back, your debt. This is the core of our modern fractional reserve banking system. The fractional part means a bank only has to keep a small fraction of its total deposits in reserve, either in its vaults or with the central bank. The rest of the money, which a bank just created, can be lent out again. Your new $300,000 circulates through the economy. You pay the home seller, who deposits the money in their bank, and that bank now has new money in its deposits. Because of the fractional reserve system, that second bank can then lend out a portion of that new deposit, creating even more money. This process repeats over and over, creating a money multiplier effect. A single dollar deposited in the banking system can ultimately lead to a much larger amount of new money being created, all through the mechanism of new loans and new debt. The implications of this are enormous and come with their own set of underwater stones. The first and most significant is that our entire money supply is fundamentally tied to debt. For every dollar created by a bank, a corresponding debt is created. This means that if everyone were to pay off all their debts at once, the money supply would shrink dramatically, likely causing an economic collapse. This constant cycle of creating money through debt is a foundational pillar of our economy, but it also means our system is dependent on a steady stream of new loans and new debt to keep from stalling. It's a powerful engine for economic growth, but it's also a potential source of instability, as we saw during the 2008 financial crisis, which was fueled by an unsustainable explosion of debt creation. The central banks, like the Federal Reserve in the US or the European Central Bank, act as the ultimate referees of this system. They don't directly type money into your account. Their job is to manage the money supply by influencing how much commercial banks lend. The central bank has several powerful tools to do this. The most famous is setting the interest rate. When the central bank raises interest rates, it becomes more expensive for commercial banks to borrow money. This, in turn, makes it more expensive for you to get a loan. When loans are more expensive, people and businesses borrow less, and the rate of money creation slows down. When the central bank lowers interest rates, the opposite happens. Loans become cheaper, borrowing increases, and money creation speeds up. The constant tension between the central bank's two main goals is a major underwater stone of our modern system. On one hand, they want to keep the economy growing and people employed. To do this, they might lower interest rates to encourage borrowing and spending. But if they do this too much, or if the economy is already running hot, the increased money supply can lead to a rise in prices, what we know as inflation. Inflation is not just prices going up, it's the value of your money going down. The currency you hold today is worth less tomorrow. A little bit of inflation is considered healthy for a growing economy, but too much can destroy people's savings and cause economic chaos. On the other hand, the danger of deflation is just as serious. When prices fall consistently, people tend to delay purchases, hoping that items will be even cheaper tomorrow. This drop in spending can lead to a dangerous spiral where businesses cut production and lay off workers, which in turn reduces spending even more. Central banks, therefore, walk a tightrope, constantly trying to maintain a healthy balance, and their decisions can have massive, real-world consequences for everyone. The digital revolution has amplified these processes to an incredible degree. Money now zips across the globe at the speed of light, and the vast majority of all transactions are digital. This is incredibly efficient, but it also creates a new layer of complexity. Credit cards, debit cards, and online banking are just different interfaces for interacting with the same digital numbers in the fractional reserve system. They make it even easier to borrow and spend, further fueling the creation of money and debt. This ease of access has also led to a massive increase in personal and government debt over the last few decades, a trend that many economists view with concern. This brings us to the new frontier of money, cryptocurrencies. These are different from traditional digital money in one fundamental way: they are decentralized. Traditional money, even in its digital form, is controlled by a central authority, a central bank and commercial banks. Cryptocurrencies like Bitcoin, on the other hand, exist on a decentralized network with no single entity in control. Their value is not based on government decree or a bank's ability to lend, but on a mathematical algorithm and the trust of its users in that algorithm. They were born out of a desire to create a form of money free from the control of banks and governments, and they are built on a technology called blockchain, a public, immutable ledger that records every transaction. While they promise transparency and independence, cryptocurrencies come with their own set of challenges, including extreme price volatility, massive energy consumption for mining, and a lack of regulation that makes them risky for many people. Interestingly, central banks around the world are now exploring the creation of their own central bank digital currencies, CBDCs. A CBDC would be the ultimate form of digital money, issued directly by the central bank and having the same legal status as physical cash. This would be a huge change from the current system where commercial banks create most of the money. Proponents argue that CBDCs could make payments faster, more secure, and cheaper. However, critics raise concerns about privacy, as a central bank could potentially track every single transaction, a level of surveillance that is impossible with physical cash. So, where do we stand today? We live in a world where money is no longer a physical object. It's a shared belief system, a massive digital ledger of numbers created by commercial banks and managed by central banks. It's an incredibly powerful system that has enabled unprecedented economic growth and innovation. But it's also a system built on debt and managed by a delicate balance of inflation and employment goals. The story of money is a story of trust. From the ancient villagers who trusted that shells had value, to the goldsmiths who trusted that not everyone would ask for their gold back at once, to us today, who trust that the central bank will manage the system wisely and that the numbers on our screen will hold their value. This trust is the final ingredient, the invisible glue that holds our entire financial world together. The question for the future is whether that trust will continue to be placed in central banks and governments, or if the rise of new digital forms of money will force us to find a new foundation for our financial world. The answer to that question will define the next chapter in the long and surprising history of money.